Linc Energy is an Australian energy company specialising in finding and producing oils, gases and fuels. It's basically one of the many Australian mining companies. And in South Australia near Coober Pedy, they bought land to try and find oil. And that's fundamentally what the mining game's about. You buy a plot of land where you think there's going to be oil or gold or zinc, and then you explore it, you hopefully find it, and then you dig it up and sell it, and you make a lot of money. And in January 2013, Linc announced that they had discovered a very large shale oil deposit. Now, shale oil is basically a different type of oil. It can use for the exact same things. So this is a huge announcement. It's basically saying we found a lot of oil. And in the lead up to that announcement, there was actually a bit of expectation that Linc were about to find something substantial. So you can see from the start of January 2013 to January 23rd, share price went up from about $7.50 up to about $13. So people were very, very expectant that Linc were going to find a lot of oil. So the actual announcement that Linc made to the Australian Securities Exchange was on the 24th of January 2013. Two independent consultants estimate there is an unrisked prospective resource of up to 223 billion barrels of oil equivalent in 3 shale formations. So there's a little bit of industry jargon there. What's an unrisked prospective resource? Well, unless you're in that industry, it's really hard to tell. It sounds risk-free, basically. It uses the term unrisked. And also, it's got 223 billion barrels of oil equivalent. What's an oil equivalent? And is 223 billion barrels a lot? I mean, it's a big number, but is that big in terms of barrels of oil? So let's have a look at that in terms of scale. Prior to Linc's discovery, if you go and get all the oil reserves in Australia, there was 25 billion barrels by 2012, and Linc's announcement was that they had found 223 billion barrels. So clearly, this is a huge prospective find and a game changer for not only Linc but the whole Australian oil industry. Looking at how much estimated revenue Linc were hoping to get from this, well, you can see the price of oil in 2013 was US $95 a barrel. Multiply that by 223 billion barrels, and you actually get a figure of about $20 trillion. That's not million, not billion, that's 20 trillion, which is 23 zeros, 3 zeros, 3 zeros, and 3 more zeros. So clearly this would make it Linc the biggest company in Australia, basically, and one of the biggest companies in the world, if they could go and dig this oil up and sell it. However, what's important to note is that their CEO, Peter Bond, at the time, did the right thing, and he came out and said, well, $20 trillion, I'm not really sure where this number's come from. It's certainly not our valuation. I don't know who did it, but someone's got a calculator out and come up with that number. We wouldn't put a valuation on it at this stage. It's too hard. So basically what people have done is got that US oil per barrel price of $95 and times it by the 233 billion barrels and come up with a figure of $20 trillion. And it's important to note the CEO actually said in the media that's not how you value oil resources anyway. But try telling that to the share market. So we saw up to January 23rd there was a lot of expectation, and then we can see on the actual day of the announcement the share price went up again by a staggering 24% in one day. So clearly people saw the news that there was a lot of oil found, and they didn't listen to what the CEO was saying. Because 3 years later, the company actually entered administration. So on the 15th of April 2016, Linc Energy entered voluntary administration with the oil and gas focused company buckling under an ongoing debt restructure and recapitalisation. Linc once boasted a market value of $2 billion when listed in Australia, and it was worth only $15 million when its Singapore listed shares last traded in March. So yet another company that's gone broke into administration and actually has subsequently gone into liquidation. And that seems pretty staggering given the news that we've heard about the 223 billion barrels of oil. So what about the $20 trillion? How can the company go broke 3 years later after finding that much oil? And that's all because that never actually happened. The estimated reserves never went on to become revenue for the company. And that's because basically finding oil doesn't mean oil's actually been found. It's actually a really tough game. Just because you think you've got oil, you've got to ask a few important questions. How far down is it? Now, if it's right below the surface, that's really easy to dig up and it doesn't cost a lot of money. But if it's way, way down, meters and meters and kilometers deep under the earth, that's going to cost a lot of money to develop the infrastructure to dig it out and then get it out and turn it into something that we can sell. Another question is, well, is it actually good quality oil? Because oils ain't oils. There can be good quality oil, there can be bad quality oil. And what's important to note is that Linc Energy never promised anything. In 2013, they basically said the unrisked prospective resource is actually the lowest category of certainty. It's got a lack of commerciality or sufficient drilling capacity. They actually told everybody this is really hard to dig up. And if we can, it's actually not that great a quality oil anyway. What about the consultants? They actually said, so remember the estimate was from two quote-unquote independent consultants. They actually said there's no certainty any of this oil will be discovered, and if it is discovered, whether it will be commercially viable. So that's the important information, but obviously no one read that. What about if we actually can dig the oil up and it's good quality and we can sell it? What price are we going to get? Well, at the time it was $95 a barrel, but you can see in the subsequent 3 years the price of oil halved. It's now below $50 and it's got as low as $35. So clearly, even if we could dig it up, it wasn't ever going to be worth $20 trillion anyway. So I think to use accounting theory to not lose money, we want to relate this to Linc Energy and say, look, that potential oil find in January 2013 was very important. Why is it important? Because it was relevant. It's relevant if it influences our decision making by helping us evaluate past or future decisions and confirm or correct past decisions. So clearly a lot of people would have made decisions about buying and selling Linc Energy shares based on this important information. There's no doubt about that. But what it needs to be weighed up with is the fact that we want to you also look at reliability. And that means information's reliable if it's free of estimates and there's a source document to back it up. So here's the original statement from January 2013, and we showed that at the start of this video about the 223 billion barrels of oil. What we're missing though is this word here. It actually says that was an estimate. So estimates are no good unless they're backed up by a source document, and also we shouldn't, if we're going to follow reliability, actually recognize this anyway. What about conservatism? Well, that says we should also use some caution. What do we mean by that? We mean if there's a loss, we recognize it when expected. But in this case, a gain is only recognized once it's certain to happen, i.e. it's actually been earned. Just thinking you've found oil doesn't mean you have it, doesn't mean you've dug it out of the ground, and doesn't mean it's good quality and you've actually made what everybody thought was $20 trillion of revenue sales of oil. So this case study represents a really good example, and it's interesting to note at the time the CEO was he was the one that was right and said, look, let's just relax. This is only a potential finding. There's no certainties here, but everybody sort of went with a relevance perspective when they really should have been balancing that with reliability and foregoing estimates, and also being really conservative and only recognizing a gain when certain. And if you can do that, that's always going to be a good way to make sure you don't lose money on prospective investments.